I got a whole lot of different takes on this. First of all, the short sellers didn't learn their lesson last time around. Second of all, retail investors are back with a vengeance, but you can't really call this investing either. These are massive swings. As a former SEC chair, what do you think when you look at all of this?
Well, it bothers me. It bothers me on many levels. I think your last guest got it right. It's a lot closer to gambling than it is to trading, and it's certainly not investing. And, is a tweet really investment advice?
Coming up today, an update on the meme lord, the swamp coming after him, US banks on the brink of collapse, is the US economy starting to crack, and Indian stocks get crushed. Hey, what's up guys? Welcome back to the Daily Market Review. And big thanks to everybody who chimed in yesterday in regards to the ongoing saga between Roaring Kitty, aka Keith Gill, and him sharing his monster long position in GameStop on social media, causing a spike in the shares and the potential blowback that it's causing, all of which I'll get into in a second. But as always, let me start off by updating you on the moves we got out of major markets today. S&P 500 forming an inside day. Volatility coiling up here, with bond yields and oil pulling back further today, along with the dollar. Actually got defensive sectors taking the lead here, and breadth softening a little bit today, with the Magnificent 7 leading the pack, and the Russell 2000 down 1.3%. NYSE volume breadth, not the best today, still didn't take out lows. Same with NASDAQ volume breadth, although we did have stocks making new lows, outpacing new highs today. However, new lows are not breaking out, nor are new highs breaking down to new lows. VIX pretty much steady there at 13, although we do have volatility risk premium climbing a little bit here, along with some moves higher in bond market volatility and oil volatility picking up this last week as well. Now we've got the 2-year bond yield coming down again to 4.77. Same with the 10-year. Down to the support zone around 4.33. Still got high yield bonds holding up above the 50-day VWAP though, and signs of liquidity still looking good, like we can see in Bitcoin moving up 2.6% today. And like I've been saying over the last 2 weeks, I think this is ripe for a breakout above all-time highs coming days, week or so. That'll be above $73,800. We are having a bit of a pullback in commodities this last week, and that's thanks to the most influential one of them all, crude oil, now getting back down into this support zone under $73 a barrel. And so overall, while we're a little soft here in breadth today, I'm still bullish on the market, still think it's overall well supported. And stick with me because I'm going to show you some other seasonal charts of why I think that's the case, along with some other interesting data as well. First, let's just follow up on yesterday's main story in GameStop, and just looking at the price action today. Finished down 5.3%, tracking upwards a little bit after hours as I speak. Still heavy volume though, 51 million shares traded today. And just looking on Reddit at Keith Gill's account, he hasn't posted any fresh updates since yesterday after close, in which he was still showing holding 5 million shares in GameStop and 120,000 call option contracts, which, if he decided to exercise before they expire on the 21st of this month, if he was able to finance it, that could result in an additional 12 million shares being put into his account. Otherwise, he might sell those options before they expire. And as a lot of you guys commented yesterday on the video, if E-Trade, who are owned by Morgan Stanley, go ahead and ban Keith Gill, could cause a huge backlash and just proves all the accusations against Wall Street as being true and not really in favor of the small trader, as it's totally fine for large hedge funds to post their positions, even go on CNBC for 30 minutes and talk up their positions. But if a regular suburban retail trader posts his positions on X, then he should be sent to jail, they say. And why is that? Just because he's more effective at doing what all those hedge funds try to do when they talk up their stock in mainstream media as well. Bit hypocritical if you ask me. But it's not only just Wall Street, Morgan Stanley not too happy about this guy. It's also the Massachusetts security regulator, the state in which Keith Gill resides, apparently looking into his activities, with a spokesperson for them saying, "There's not much more I can say at this point, other than they're looking into his activities." And so he's already attracting all this scrutiny. And some say he's the ultimate diamond hands trader out there. I'd take it a step further and say he's actually got diamond balls, not only for the numbers he's swinging around and staying all in on GameStop this whole time. It's kind of remarkable. We thought it was crazy back in 21, him just staying in there. And now he's come out with hundreds of millions of dollars worth of shares. It's truly incredible. But he's not only got the stomach for that huge position, but he knows regulators are watching him. He knows Wall Street hates him. They hate the idea of retail traders going against them, making a mockery of them, and them abusing the rules of borrowing shares to short that don't even exist. So maybe he's happy to go back to court and shine a spotlight on this whole thing. He's definitely got the budget to fight anyone now. However, just like we've seen recently from the establishment, could be another case of selective punishment against those that make a mockery of the establishment and their friends. However, just looking at the facts, Massachusetts politicians have been trading themselves, including Catherine Clark, who sits on the Congressional Subcommittee of Labor, Health and Human Services. She bought shares in HoloLogic a week before the US Department of Health awarded the company a $119 million COVID-19 contract. She sold after the shares spiked days later. Several other cases of politicians from that state also making very well-timed trades in companies and industries where they have privileged information and can influence the outcome directly. That's all fine to do, according to them. However, if a suburban retail trader posts some memes online, then he should be locked up, because how else are Congress members going to amass billions of dollars in personal wealth whilst being on already generous salaries, $174,000 on average? And it's not just the politicians that hate this type of stuff, it's also the market makers, who again bend the rules for their own benefit, selling shares that don't exist, then getting their friends at the SEC to also put pressure and start monitoring the trades of a suburban guy, while totally ignoring or the flouting of the rules by the biggest market makers out there. However, stepping back from all that, JP Morgan has said the meme stock's resurgence is a bad sign for markets, with their top strategist, Marko Klanovic, reiterating his gloomy stock view because of high interest rates and retail speculation. With some saying Roaring Kitty is taking GameStop to fantasy land and no short squeeze is coming, there is some truth to that. There's nowhere near the same amount of shares short on GameStop now compared to back in 2021, with the current short percentage somewhere around 23%, whereas back then it was somewhere between 150 and 300% according to some measures. But who really knows, since it's all such a dark and muddy world when it comes to apparently borrowing shares to short. It's not only meme stocks JP Morgan is bearish about. They think the whole market's about to hit a wall this summer, with the upside capped due to the inconsistency between a consensus call for disinflation and at the same time the belief in no landing and earnings acceleration. And you may have heard the 63 banks, $517 billion in unrealized losses that are on the brink of collapse. Well, I disagree with the narrative from this headline and what some are extrapolating from it, because basically it's just big unrealized losses on their balance sheets with bonds that they've bought over the last couple of years, especially back in 2020 when rates were low. And that's totally fine and normal and no problem at all if the bonds are held to maturity, because they'll get their coupon and their principal back. The only problem is if those losses have to be realized and the bonds liquidated, and I can tell you right now, I'd almost guarantee it, the Fed will never allow that to happen. They're already working with these banks. They will pull out whatever stop they need to. They will print however many trillions needed to backstop the system, because they will not let this spill over, as it could spill over worse in 2008 with all the commercial real estate as well. And the market knows this. The Fed put is more well and alive than it's ever been. And so in my opinion, it's actually bullish. And I know that sounds ridiculous, but we no longer live in a world of true free market capitalism, because if we did, then this would be bad and the logic would play out. However, like I said, we have huge interventionist policies from the Federal Reserve, corporate socialism, skirting of laws, while capitalism and the rule of law for the rest of us. So I'd be very surprised if they let more than one or two banks go under before fully backstopping the whole system. And just looking at the price action and regional bank ETFs, market doesn't look too worried at all, because I think it knows all that very well. Same with the junk bond market. It's not trading in any signs of distress. Actually, junk bond yields over treasuries are near record lows. Market's very comfortable and loose. And just looking at XLF financials, they're actually in a good uptrend and would probably stand to benefit if we had another little mini crisis, because they could just gobble up some of those banks in distress, again with a fully brokered and backstopped deal courtesy of the Fed. So in my opinion, it's a nothing burger. And contrary to popular belief, this bull market still may have a lot more left in it before it finds its inevitable top. Looking at cyclical bull markets in history, median duration is around 31 months. We're currently approaching 21 months, and we're almost at the mid-range of performance in previous similar bull markets. Not only that, we are 100% in a low volatility regime as well. 322 trading days since we've had a 2% down day. And the fact is, low volatility regimes can last a lot longer than you think. Saw that in the mid-90s, in the mid-2000s, in the mid-2010s, again in the late 2010s. Maybe we're going in for another period of that here in the mid-2020. Not only that, but seasonalities are bullish as well. Looking at the S&P 500 in history, whenever we had a 4% gain in May, like we just did this year, the average gain for the rest of the year is very strong at 10.5%. Not only that, but when the S&P is up more than 10% year to date by the end of May, again, the average gain comes in at 8.8% higher 84% of the time. So anyone bearish out there thinks we're going to finish lower by the end of the year, especially in an election year, especially with this government and all the stops they're willing to pull out, prop things up. I'd say your odds are less than 16% that happens. Doesn't mean it can't, doesn't mean we can't get a surprise. It's just this same setup over 100 times. It's probably less than 16 times we'll finish lower. Very tough to bet against. Plus the strong just keep getting stronger. Here's the man of the hour, Jensen Huang, signing a fan's shirt at a recent conference. And NVDA again broke out to new all-time highs, closing in on the big 1200 level. And I've calculated it somewhere around 1260, where it'll become the largest company in the world. And we could get a rip going into the split this coming Monday on the 10th. And that could mark a bit of a line in the sand where we may actually pull back and turn around. However, like I've been saying, for the stock market to roll over, we'd really need NVIDIA to roll over. Otherwise, it's just going to help keep the indices elevated. However, is the underlying US economy starting to crack? We do have a bunch of contrasting data out there, with another print today showing job openings falling to a new 3-year low. Some saying that's another sign the economy is continuing to slow. That's because there were 8.06 million available jobs posted in April versus what economists were expecting at 8.36. However, it's not all as bad as it seems. Just looking at the amount of people that have been laid off, it's actually the lowest since December 2022. And that doesn't mean people, instead of getting fired, are just quitting, because looking at the quit rate, that's actually below pre-COVID levels as well. And we'll get a really good look this Friday when we get non-farm payrolls, jobs report, unemployment rate expected to be 3.9%. So overall, the jobs market is still holding up. However, for sure, there's more room for that unemployment rate to spike higher than lower. But the bond market is reacting. Just looking at the tape, yields are pulling back. May see further weakness coming, or maybe a bit surprised on the PCE and other economic prints we've had since then, as yields were firming into that. Or maybe there's just a natural ceiling in the 2-year yield at the moment, around 5%. Because last time we were there, Jay Powell and Janet Yellen came out, talk them down. Market may be leaning against that a bit. And we saw that as well back in October. Market traded up a bit above 5%. Jay Powell, Janet Yellen came out, did a great job at getting those yields down. So it could be we're just in for a period of consolidation here for bond yields. But like I said, there's contrasting data, because US factory orders actually rose for the 3rd straight month. And up until about 4-6 months ago, we'd really been seeing weak manufacturing. However, that's picked up a lot, thanks especially to high tech, AI, data centers. Just looking at a chart of real computer, electronic, and electrical construction spending, that's actually booming, up 1,000% since December 2020. And even in the economy, maybe softening a little bit, definitely with consumers' discretionary spending. Doesn't mean inflation is likely to come down to the Fed's 2% target anytime soon. Just like former Treasury Secretary Larry Summers has been arguing as well. Could have structurally higher inflation, who knows, potentially for decades after the Fed's huge financial experiment in printing $9 trillion. Somehow the system's supposed to absorb all of that, and inflation's just going to last a year or two, maybe not. What could definitely help inflation just around the corner is oil pulling back. But the market had been looking for more production cuts coming out of OPEC+, and since supply is still flush in the States, and how elastic demand and supply can be, if oil goes up, people drive less, kind of keeps a natural lid on it. Not to mention, again, the structural implications of the Biden administration releasing a lot from their strategic reserves, having a material effect on the oil market these past couple of years as well, along with giving indications they'll do it again if oil pops up big for the market to lean against. And so even though commodities have been a bull right out of the gate this year, we're having a bit of a pullback this week. That is to be expected. Just looking at the commodity index, average seasonality pattern over the year here in the blue line, we do see a bit of weakness going into mid-year before it can be a bit of a buy the dip opportunity. And so here we are in the red line. They've just got a bit ahead of itself and a bit of volatility coming in along with this pullback. We can see that there in the commodity index ETF DBC. Starting to get technically oversold here. However, it still may have a little more room to run and come back down to this past area of congestion from the start of the year, where I'd expect it to find support. Gold's still holding up better though, along with agricultural commodities. Soft's doing a lot better than energies and metals here. Moving on from commodities, we have Indian stocks getting crushed today, as even though Prime Minister Modi won, it was an upsetting result, as they appeared to have just narrowly secured a 3rd term while losing his outright majority. Losing a bit of political power, as it was widely expected he would win in a landslide. That wasn't the case, and so the market is now pricing in a bit more political instability over there and pro-market policy to be threatening. And we can see what a huge reversal and candlestick that is in the Nifty 50 index. You could kind of think of that as the Dow Jones Industrial of India. Getting absolutely clobbered, down 6% in Tuesday's session. It spilled over to the iShares India ETF traded in the States. Looks like investors bought that dip though. Over to the economic calendar, there are the prints we got today on JOLTS versus expectations, factory orders. Get a look at Australia GDP growth data soon. A few PMIs tomorrow, along with the interest rate decision from the Bank of Canada. expected to cut rates. Going into Thursday, get the interest rate decision from the ECB, also expected to cut rates. And Friday, the big one, non-farm payrolls. Unemployment rate expected to come in at 3.9%. And with that softer economic print today, Fed Fund futures have firmed the chance the Fed will cut in September, now currently around 2/3 chance we're going to see a cut this year. And surprisingly, even though we got the VIX at 13, really low, fear and greed index back in the fear zone, and corporate insiders still not doing a whole lot of trading here. Chinese stocks looking to find support at the 50-day VWAP. Global stocks pulling back a little bit. Canada's TSX, UK FTSE, the German DAX, there's China's 50 index, the Nikkei 225, and the Aussie 200 still trading pretty thick and consolidating. Just looking at spread charts, we've got the Nasdaq versus the Russell 2000 close to breaking out again, showing big growth stocks taking the lead. And we can also see that in my sector analysis indicator. Looking at the 6 major factors and their performance over the last year, just keep in mind that it's still momentum and growth stocks leading this market, which is really bullish, with low volatility in dividend stocks, still well below the performance of growth. Bit of a sharp pullback in the spread of copper versus gold, but high yield bonds testing their upward channel against treasuries here. Shipping stocks having a bit of a breather. Retail stocks turning back down. Discretionary still a bit soft. Home builders turning down, along with consolidations for industrials. One of the best performing sectors, aerospace and defense, still close to all-time highs, along with consumer staples and utilities. Strongest sectors right here. There's MSOS just fired off the 5th and last possible reversal signal here of mine. Last time we got those reversal signals back in March proved to be a low, and again back in late October as well. So we'll see whether this plays out again and this support zone can hold. There's Apple firming up again, high highs, high lows. Price action's pretty constructive here. And there's Microsoft. And if it keeps consolidating and NVDA keeps running, like I said, we're less than 10% away from it becoming the biggest company in the world, which could happen before it splits this coming Monday. Tesla still consolidating just above the 50-day VWAP. And just as I'd been thinking, this price action on A-Mark is a little suspicious. Maybe getting confirmation of that today, and I could be close to bailing on this one for the time being, waiting for a bit more technical strength and maybe their next earnings report, see if that comes in better. And even though bond yields have been pulling back, we've still got a little bit of weakness in the big banks here. JP Morgan still consolidating. Okay, there we are for this Tuesday session. Market coiling up. Like I said, volatility is low, yields have pulled back, oil's pulled back, along with the dollar and inflation expectations. That's all good for the stock market. However, as I just showed you, breadth is a little soft as well, and we may just keep coiling up for the next 2 sessions as we go into jobs market report on Friday, and we could get the move and uncoiling then, up or down. But until then, we'll follow the data, we'll follow the tape, and we'll just see what happens. Thanks very much for tuning in and hitting that like button. I'll see you again tomorrow night.